So in this video, I'm going to teach you how to build a two-fund portfolio in Australia. This is simply using an Australian ETF paired with a global ETF. And these are both equity funds, so this is a 100% stock portfolio. So there are so many different ways to build a two-fund portfolio, especially with the asset allocation. Having your Australian equity allocation between 15 and 35% should make you a pretty good mix. But now we need to find some ETFs to pair with these asset classes. For dimensional, you can create a value portfolio using DAVA and DGVA. With Global X, you can create a GARP portfolio. This means growth at a reasonable price. This is GRPA for the Australian product and GARP for the global product. I found it very interesting that JP Morgan didn't have an Australian ETF, but there's all the indexes. You'll notice by the end of all these ETFs I'm showing you, they basically hit every Australian possible product. But JP Morgan does have JREG. Van Eck can help you pair an equal weight Australian fund with an international wide moat. This is MVW and GOAT. The major providers are beta shares. You can use A200 and BGBL. And why the rest of the three are green, these are the ones we're going to backtest. So you can use ILC and IOO from BlackRock. This portfolio is just targeting the large companies, the ASX 20 and the Global 100, the largest 100 companies around the world. SFY and QMix from State Street is going to help you invest in the ASX 50 and the MSCI World Quality Mix. And Vanguard invests in the total Australian market with VAS, and VGS spreads your money all around the world. The main reason why I chose to compare these products is there's a lot of history. It's really a good idea to look back at least 5 years when comparing products. So in this comparison, I started off with $100,000 and I used the 25 Australian, 75% global split. In 10 years, the Vanguard combination grew to 324,000, the BlackRock combination grew to 385,000, and the State Street combination grew to 294,000. State Street had the lowest standard deviation, BlackRock had the best year, State Street lost the least in the worst year, BlackRock had the lowest max drawdown, and BlackRock had the best Sharpe ratio. So even though the Vanguard product grew about $30,000 more than State Street, it was more volatile, so the Sharpe ratios are similar. But you can mix and match whatever ETFs you want. VHY, the Vanguard Australian Shares High Yield ETF, and IOO, the iShares Global 100 ETF, seem to make the best combinations looking at different time horizons and rolling returns. Looking back almost 11 years this time, the Vanguard combination grew to almost 350,000, the BlackRock combination grew to just over 400,000, and using 25% VHY and 75% IOO grew to 408,000. This isn't a life-changing difference, but everyone I know is trying to make more money. Taking a closer look at the metrics, the custom combo had the best compound annual growth rate, all the standard deviations were basically the same. BlackRock and the custom combo had very similar best years. The custom combo lost the least amount in the worst year. The BlackRock combo did have a slightly better max drawdown, but the custom combination just had a barely better Sharpe ratio. Testing out the various Australian global splits, we can look back over 14 years using just VHY and IOO. And there seems to be an inverse relationship with the more home country bias you have, the less money your portfolio grew to. I'm certainly not saying put $0 in Australia, but using a two-fund portfolio is the easiest way to really dictate how much you want to put in Australian equities. And the Sharpe ratios really aren't that different considering we're comparing 35% in Australia to 15% in Australia. This is quite a big difference. And there's only a 0.05 difference in the Sharpe ratio. But that's why I showed you plenty of examples at the beginning of the video. I also wanted to note that most of these all-equity combinations avoid the emerging markets. This seems to be the first asset class that investors like to avoid. It is the most volatile and risky asset class, and this is really just personal preference if you want to avoid emerging markets.